What if the biggest threat to your wealth isn't a crash, but tiny fees you barely notice? Quick question. Do you want excitement or results? Because most investors don't lose to bad markets. They lose to bad behavior, chasing winners, panic selling, and paying hidden costs. Have you ever felt the urge to do something when headlines turn scary? Have you ever bought what everyone was bragging about right before it cooled off? Here's the promise. In this video, you'll learn one simple approach designed to capture your fair share of market returns, without the stress, the guesswork, or the constant trading. Hey, I'm Dave. On this channel, I take the most powerful ideas from the best books on money and personal growth, and I turn them into clear, practical steps you can actually use, so you can build wealth without building stress. Let me ask you, what do you really want from investing? More charts or more freedom? More predictions or more certainty? Because today's book, The Little Book of Common Sense Investing, has one mission: to help everyday people stop losing the game they didn't even know they were playing. And here's what you'll get by the end of this video. You'll understand why trying to beat the market is harder than it looks, why costs and taxes quietly destroy returns, and why your behavior matters even more than your IQ. You'll also walk away with a simple set and stay framework you can use whether you're starting with $100 or $100,000. So as we go, I want you to keep asking yourself one question. Am I building a plan I can stick with for decades, or am I chasing feelings week to week? If you're ready, let's start with the core idea that changes everything. What if I told you the smartest move in investing is to stop trying to be smarter than everyone else? Here's the entire book in one sentence. Own the whole market, keep your costs brutally low, and stay the course. Now let me ask you a hard question. When you try to beat the market, who exactly are you trying to beat? It's not a machine, it's other investors, millions of them, plus professional managers who do this full time, with teams, research budgets, and constant access to information. Before costs, all investors as a group earn the market return. That's just how averages work. But after costs, fees, trading spreads, taxes, commissions, the group earns less than the market because money leaks out of the system. So if the average investor must earn the market return before costs, and costs pull returns down, why choose a strategy that increases costs and increases trading? That's the logic behind index investing. It's not lazy, it's honest math. Instead of guessing which stock will win, which sector will explode, or which manager is a genius, you buy a low-cost index fund that owns a broad slice of the entire market. You accept the market return, and you focus on the one part you can control: how much of that return you keep. Let's make this painfully real. Imagine two people invest in the same market for the next 30 years. Person A wants excitement. They chase hot funds. They react to headlines. They switch strategies when fear hits. Every move feels productive because they're doing something. Person B wants results. They buy the whole market at very low cost, keep adding money consistently, and ignore noise. They rebalance occasionally and keep going. Who feels smarter in the short term? Usually person A. Question: who tends to win in the long term? Usually person B, because the real enemy isn't the market, it's friction. And friction is everywhere. High expense ratios that quietly siphon returns every year, constant turnover that creates hidden trading costs, and emotional decisions like panic selling and buying back later at higher prices. Have you ever sold just to feel relief, then watched the market rebound without you? Have you ever bought what everyone was bragging about, only to see it cool off right after? That's not a knowledge problem. That's a behavior problem. This is why Bogle's approach is also personal growth. It reduces decision points. It reduces temptation. It turns investing from a stressful guessing game into a simple ownership plan. So here's the core question I want you to carry through the rest of this video. Are you investing to feel in control today, or to be free tomorrow? Because in this book's worldview, boring is not a drawback. Boring is the strategy. Let's go deeper, because if you don't understand where returns come from, you'll always be tempted to chase noise. So here's the question. When you make money in the stock market, what are you actually getting paid for? Most people think returns come from being clever, timing the bottom, predicting the next rally, spotting the next winner. But this book forces you to separate two very different forces: the real economics of business, the emotional voting machine of the market. And if you mix them up, you'll make expensive decisions. Let's start with the real part, business reality. When you own stocks, you own businesses. Over the long run, businesses create value in pretty boring ways. They sell products and services. They earn profits. They reinvest those profits to grow. And they often return some of those profits to owners through dividends. So in the long run, your return is driven by dividend yield, the cash businesses pay you, and earnings growth, the increase in what businesses can earn over time. That's the foundation. That's the engine. Now here's the trap. In the short run, stock prices move like they're on caffeine. Why? Because price is not just business value. Price is what investors are willing to pay today for that value. And what investors are willing to pay changes with mood, fear, greed, excitement, and sometimes pure stories. So let me ask you, have you ever seen a great business have a terrible stock year? Have you ever seen a questionable business have an amazing stock year? Of course you have, because the market is not only a weighing machine, it's also a voting machine. In the short term, it votes on popularity. In the long term, it weighs fundamentals. Here's a real lifestyle example. Imagine you own a small coffee shop with your friend. The shop makes steady profit every year. Nothing dramatic happens, just consistent customers, consistent revenue, consistent growth. Now imagine every day strangers shout a new price at you. Today your shop is worth double. Tomorrow it's worth half. Next week it's back up. Would you sell the shop just because someone shouted a low number? Or would you ask, did our profits change? Did our customers disappear? Did our business break? That's the mindset shift the book wants from you. Because if the business engine is still running, a lower price isn't a signal to panic. It can be a signal to keep owning, and maybe even buy more. Now, let's connect this to something you felt personally. When markets fall, headlines get loud. People around you get nervous. Your brain starts doing survival math. What if this keeps dropping? What if I lose everything? What if I should get out now and come back later? Question: how many times have you told yourself, I'll sell now and buy back when things feel safer? And the next question, when does it ever feel safe? That's the psychological trap, because the market often feels safest near the top, when everyone is confident. And it feels most dangerous near the bottom, when prices are actually lower and future returns can be higher. So Bogle's deeper point is not just about economics, it's about identity. Are you an owner or are you a renter? Renters react to price. Owners focus on value. And this is why index investing works so well with human behavior. If you accept that short-term price changes are mostly noise and long-term returns come from business fundamentals, then your job becomes simple. Own productive assets. Hold them long enough for reality to matter. Ignore the emotional storms. Now here's a powerful question to lock this in. If you can't predict short-term market moods, why let those moods control your financial future? Because when you zoom out, the market return is a reflection of capitalism doing its job. Companies innovate, productivity increases, earnings grow, dividends get paid, and patient owners participate in that growth. So the goal isn't to win the next month. The goal is to stay invested long enough to let the business engine compound. And that leads to the next segment, because once you understand where returns come from, the next question is, what's the smartest way to own the market without taking unnecessary risks? Here's the big question. If the market return is driven by business fundamentals over the long run, what's the smartest way to own those businesses? Most people answer with effort. I'll pick the best stocks. I'll find the best manager. I'll rotate into the best sector. But Bogle's argument is simple, and honestly, a little humiliating for our ego. Your biggest investing wins don't come from being clever. They come from avoiding unnecessary mistakes. So what does an index fund really do? An index fund is designed to own a broad basket of stocks that represents the market, rather than trying to outguess it. Instead of making a manager decide, buy this, sell that, the fund simply holds what the market holds, usually weighted by market value. In other words, it's an ownership machine, not a prediction machine. Now let me ask you, when you buy a single stock, what risks are you taking? You're taking company risk, that one business could stumble, get disrupted, get sued, or simply fall out of favor. Even great companies can have long stretches of disappointing performance. When you buy a handful of stocks, you reduce that a bit, but you still carry a ton of idiosyncratic risk, because your portfolio depends on your choices being right. So here's the first risk an index fund removes: stock selection risk. You don't need to guess the winners because you own them all. Now ask, what about choosing a fund manager? Active managers don't just pick stocks. They pick timing, they pick how concentrated to be, they pick style bets, they pick sector weights, they pick when to hold cash. And the uncomfortable reality is that even skilled managers face huge headwinds: competition, changing market regimes, and most importantly, costs. So here's the second risk an index fund removes: manager selection risk. You don't have to find the next star manager. You don't have to worry if they leave. You don't have to wonder if the strategy stops working once the fund gets too big. Now let me ask a more personal question. How many times have you felt uncertain about what to buy? Because uncertainty creates stress, and stress creates bad decisions. Index funds reduce stress by reducing decisions, and that matters because your behavior is a major determinant of your results. Now, there's a third risk people don't talk about enough: style and sector risk. Let's make it real. One year, tech is everything. Then energy explodes. Then value stocks come back. Then small caps lead. Then international markets shine. Then everyone says, this time is different. If you're constantly trying to rotate into the best category, you're not investing, you're guessing. And guessing feels smart until it doesn't. A broad index fund holds a wide mix, so you don't have to predict which corner of the market will lead next. You participate in whatever wins, without needing to time it. So here's the deeper philosophy. Index investing doesn't eliminate market risk. Nothing does. But it removes avoidable risks that don't reliably pay you. Let me say that again. It removes risks you don't get compensated for. Because in finance, some risks pay you. Market risk can pay you over time. But unnecessary concentration, chasing managers, constant style rotation, those risks often just increase your chance of being wrong. Now, I want you to picture two versions of you. Version A builds a complicated portfolio: 10 hot stocks, 6 sector ETFs, 3 tactical funds, and a constant stream of adjustments. They feel busy, but they're always anxious. Did I pick the right ones? Should I sell now? What if I'm missing the next trend? Version B builds a simple portfolio: a broad, low-cost index fund, or a small set of broad index funds. They focus on saving more, investing regularly, and staying calm. Which version of you is more likely to stick with the plan for 20 years? Because the best strategy on paper is worthless if you abandon it in real life. And that's why Bogle's approach is so powerful. It aligns good investing with normal human psychology. Less decisions, less temptation, less regret. And now we're ready for the next step, because once you understand what an index fund does, the next question is, why do costs matter so much that they can decide your entire financial future? Let's go straight to the uncomfortable question. If compounding is the engine that builds wealth, why do so many investors never feel rich? Because there's a silent war happening inside your portfolio. Compounding is trying to grow your money. Costs are trying to drain it. Every single year. And the scary part? Costs don't look dangerous. They look small. 0.5%, 1%, 2%. Those numbers feel like nothing until you remember one thing. Compounding works on everything, including the money you lose to fees. So let me ask you, if someone offered to take only 1% of your future every year, forever, would you say yes? Most people do, without realizing it. Here's the reality Bogle keeps hammering. You don't get the market return. You get the market return minus the costs you pay to participate. And unlike market returns, which you can't predict, costs are predictable. They are the one thing you can control with certainty. Now let's make this personal. Imagine two coworkers, same age, same salary, same investment amount. They both invest in the stock market for the next 30 years. Person A chooses a low-cost index fund. Person B chooses a fund with higher fees and higher trading inside the fund. At first, their balances look similar, so Person B feels fine. But over time, Person A's money compounds on a larger base because less is leaking out. Person B's money compounds on a smaller base because every year a slice is removed before it can grow. There are also hidden trading costs. When funds buy and sell frequently, they pay spreads and transaction costs. Plus, more trading often means more taxes in taxable accounts. So you get hit from three angles: fund expenses, trading friction, taxes. All of them reduce your net return. And net return is the only return that pays your rent, your freedom, your retirement. Here's the mindset shift. Stop asking, which fund will perform best next year? Start asking, which strategy lets me keep the most of what the market gives over decades? Because a tiny leak, compounded for 30 years, becomes a flood. And that sets up the next segment, where we expose the system with a story you'll never forget: the gotrocks parable.
Let me tell you a story from the book that exposes the investing world in the simplest way possible.
Imagine a country where one family, the gotrocks, owns every public company. They own all the stocks. That means they receive 100% of what businesses produce for shareholders: dividends, earnings growth, the whole pie. Now here's the key question. If they already own the entire market, what should their strategy be? They could literally do nothing, just hold, and their wealth would naturally grow with the economy. But then something happens. Helpers show up. Brokers say, "Trade more, we'll help you win." Managers say, "Pay us, we'll beat the market for you." Consultants say, "Rotate strategies, we'll keep you safe." And the gotrocks family starts listening. They begin trading stocks back and forth among themselves. But think about this. If the family still owns the entire market collectively, can the family as a whole beat itself? No. All they can do is reshuffle who owns what, while paying costs to do it. So every trade creates a leak. Commissions, spreads, management fees, marketing fees, legal costs, administrative costs, and taxes. Over time, the helpers don't create extra pie. They just take slices from the existing pie. Now let me ask you a question that might change how you see investing forever. When a fund manager promises you outperformance, what's the one thing that is guaranteed? You will pay them, even if they underperform, even if the market goes sideways, even if their strategy stops working. The book's brutal truth is this: as a group, investors earn the market return before cost. But after the helpers take their cut, investors earn less than the market. So the gotrocks uncle gives the only advice that makes sense. Stop hiring so many helpers. Own the whole market. Minimize turnover. Minimize costs. Keep more of the pie. And now, bring it back to your life. Every time you switch funds because you're nervous, someone gets paid. Every time you chase a hot sector, someone gets paid. Every time you buy a high-fee product, someone gets paid. Is your investment strategy designed to grow your future or to feed the financial machine? Because once you see the gotrocks story, you can't unsee it. And that leads perfectly into next title, where we get specific about the costs you must watch: expense ratios, turnover, and the hidden friction that quietly destroys compounding.
Let's get practical, because this is where investors either keep their money or quietly donate it away.
If the market gives a certain return over time, what determines how much of it you actually get to keep? Answer: cost. And not just the obvious ones. Most people only notice the expense ratio, the annual fee a fund charges. But the book pushes you to think like an owner, not a shopper. Owners ask, what's the total drag on my return? So let's break down the cost checklist in a way you can actually use. First, the expense ratio. This is the visible fee, taken out every year whether markets are up or down. Now question, if two funds own basically the same market, same companies, same exposure, why would you pay more? Paying extra only makes sense if you can reliably get extra performance after the fee. And that's the problem. You can't count on that. Second, sales loads and marketing fees. These are the costs that exist primarily to sell the fund, not to grow your wealth. So ask yourself, if a fund needs a salesman to convince you, is it designed for you or for the sales system? Third, and this is the one most people miss, turnover. Turnover means how often a fund buys and sells its holdings. On the surface, turnover sounds active, smart, managed. But turnover is expensive. Every time a fund trades, it pays friction, bid-ask spreads, market impact, commissions in some cases, and other transaction costs that don't show up clearly in a simple fee number. Let me ask you, if you owned a business, would you constantly buy and sell your equipment every week just to feel productive? Or would you keep what works and let it generate cash? High turnover is often the investing version of busy work. And then there's the fourth cost, taxes, especially in taxable accounts. When funds trade frequently, they can trigger capital gains distributions. So even if you didn't sell anything, you might still get a tax bill because the fund did. Question: how does it feel to pay taxes on gains you didn't choose to realize? That's why low turnover indexing can be powerful. Less trading often means fewer taxable events, which means more money stays inside the engine, compounding. Now, let's ground this with a scenario you've probably lived. You see two funds. Fund A is boring, low cost, diversified. Fund B has a shiny story, expert managers, opportunity, tactical moves. Fund B also has higher fees and trades more. In year one, Fund B might even outperform, and your brain instantly says, "See, this is better." But the book wants you to play a longer game. What matters isn't one-year performance. What matters is the long-term net return after all costs, all years, all market cycles. So here's the key mindset. When choosing funds, don't start with, "What's the return?" Start with, "What's the drag?" Because costs are a guaranteed subtraction. Performance is a guess. Now let me give you a simple rule you can repeat like a mantra. In investing, you don't get what you don't pay for, but you also don't keep what you overpay for. So your action step from this segment is clear. When you look at any investment product, ask 4 questions. 1. What's the expense ratio? 2. Are there any loads or extra fees? 3. What's the turnover rate? How much trading is happening? 4. What's the likely tax impact for my situation? If you can answer those, you're already ahead of most investors. And next, we tackle the most expensive cost of all, your own behavior. Because even with good funds, people still sabotage themselves by buying high and selling low. Here's a question I want you to answer honestly. Have you ever made an investment decision mainly because you felt fear or excitement? If yes, you're normal. And this book is basically saying, great, now design a strategy that protects you from you. Bogle highlights a painful reality. Even when a fund has a strong long-term return, the average investor in that fund often earns less than the fund itself. Why? Because investors don't invest like machines. They chase, they panic, they delay, they overreact. This is what many people call the behavior gap, the difference between what the investment earns and what the investor actually takes home. So how does it happen? Let's walk through the most common pattern. Step 1. A fund performs well for a few years. Your friend mentions it. You see it on a top funds list. Social media starts celebrating it. Question: when do most people feel confident buying? After it already went up. So money pours in near the top. Step 2. Then the market cycle shifts. The fund underperforms for a period. Headlines turn negative. The same crowd that praised it now doubts it. When do most people feel desperate to sell? After it already went down. So they sell, near the bottom. Then what happens? A rebound comes later, and now they buy again, higher. That cycle, buy high, sell low, doesn't require you to be stupid. It only requires you to be emotional. Now let me give you a realistic life example. Imagine you're working full-time. Bills, family, goals. You finally start investing consistently. Then the market drops 20%. You open your app and see red everywhere. Your brain says, "This was a mistake. I should stop before it gets worse." So you pause your contributions or sell to wait for clarity. But clarity usually arrives after prices recover. So you re-enter when things feel safe, which often means you're paying more. Question: did the market beat you, or did your nervous system beat you? Because the market's job is to fluctuate. Your job is to not turn fluctuation into permanent damage. This is why the book loves indexing. It reduces the number of decisions you have to make. Less choices means fewer chances to panic. And fewer chances to panic means you capture more of the market's long-term return. Now here's the most important mindset shift in this segment. You don't need to be right every month. You need to be consistent for decades. And consistency is not a knowledge skill, it's a self-control skill. So I want you to adopt a simple internal script for scary markets. If businesses are still producing, then lower prices are not an emergency. They are part of the deal. Another question: what if the best time to invest is exactly when you don't feel like it? Because that's when prices are lower and future expected returns can be higher. Now, practical takeaway. If you want to shrink the behavior gap, you need rules. Automate contributions so you buy in good times and bad times. Hold a diversified index so you don't obsess over one position, and choose an asset allocation you can emotionally survive. Because the goal isn't to be fearless. The goal is to be disciplined even when you feel fear. And that brings us to next chapter, because the biggest reason people chase performance is a misunderstanding of what recent winners mean. We're going to talk about reversion to the mean, why today's star often becomes tomorrow's disappointment. And that's exactly why you need one more layer of protection. Because even if you don't panic when markets drop, you can still sabotage yourself when things look amazing. The emotional opposite of fear is hype, and hype creates one of the most expensive habits in investing: chasing performance. So let me ask you, when you see a fund that crushed it for the last 3 years, what are you really buying? Most people think they're buying skill, but often they're buying a moment in time. Bogle's point is that markets move in cycles. What's unusually hot tends to cool off. What's unusually cold often recovers. That pullback toward average is what people call reversion to the mean. And if you ignore it, you'll keep arriving late to the party. Let's make it feel like real life. Think about your workplace or your friend group. Someone has a ridiculous year. Promotion, big bonus. Everyone talks about them like they're unstoppable. You start thinking, they've got the formula. But then the environment changes. A new boss, a new competitor, a weaker economy, a different territory, a different product cycle. Suddenly, they're not unstoppable. They're human. Question: was there talent? Sure. But was there also timing and conditions? Almost always. Funds work the same way. A star fund often wins because a particular style is winning. Maybe growth stocks dominate. Maybe value comes roaring back. Maybe small caps lead. Maybe one sector catches a massive tailwind. Maybe one country has a boom. But here's the trap. You usually hear about the star after the run-up, after the headlines, after the charts look beautiful, after the crowd feels confident. So question: when do most people feel safest buying? When prices are already high and optimism is already priced in. And then, because leadership rotates, the cycle turns. Returns drift back toward average. The fund that looked like genius starts looking broken. Now you feel regret and you leave, right when the fund is no longer expensive. That's the classic buy high, sell low loop, just with a different emotion behind it. Now, let's talk about another reason this happens that almost nobody considers. Success attracts money. When a fund becomes famous, huge amounts of money pour in. But managing a small pool is different from managing a massive pool. With a small fund, you can be nimble. With a huge fund, every move is harder, opportunities get crowded, trades can move prices, and the strategy can get diluted. So the very popularity that made you trust it can reduce its ability to repeat the past. Here's a sharp question. If performance was so easy to repeat, why don't the same funds dominate every decade? Because markets are adaptive, because competitors copy, because conditions change, and because recent return is one of the most persuasive but least reliable signals for the future. So what should you do instead? Flip the question. Don't ask, what's been winning lately? Ask, what will I still believe in when it stops winning for a while? That's why broad market indexing is so powerful. It doesn't rely on one style staying hot. It doesn't rely on one manager staying brilliant. It doesn't require you to predict the next leader. You just own the market, keep costs low, and let leadership rotate inside your portfolio automatically. So the real win is not finding the next star. The win is building a plan that doesn't need stars. And once you stop chasing winners, the next decision becomes the one that quietly controls your entire experience as an investor. How much risk you take, your mix of stocks and bonds, so you can stay invested through every market cycle. Let me ask you something that sounds simple, but decides your future. How much of your money should be in stocks, and how much should be in bonds? Bogle is honest right away. There's no one perfect answer, because people have different goals, time horizons, and risk tolerance. But then he hits you with the part most people underestimate. Asset allocation explains most of the differences in long-term portfolio results. In fact, he cites a landmark study showing about 94% of the differences in total returns among pension funds came from asset allocation, not from picking the right funds. So here's a powerful question. If allocation matters that much, why do so many people spend 90% of their energy arguing about which stock or which fund is best? Because choosing a stock feels like control. Choosing an allocation feels like responsibility. Now, what do stocks and bonds actually do for you? Stocks are the growth engine. They're volatile, but historically they've been the long-term wealth builder. Bonds are the stabilizer. They usually won't make you rich, but they can help keep you sane. And being sane is not a nice to have, it's a financial advantage. Because the real goal isn't to build the highest return portfolio on paper. The goal is to build a portfolio you can actually hold when life gets loud. So let me ask, when the market drops 30%, do you want your plan to force you into panic, or to give you a structure that helps you stay calm? This is where Benjamin Graham's guidance enters like guardrails. Bogle shares Graham's range rule: never less than 25% and never more than 75% in stocks, with the inverse in bonds, implying a 50-50 starting point for many investors. Now, you don't have to worship 50-50, but you should respect the idea behind it. A good allocation is not the one that maximizes returns. It's the one that maximizes your ability to stay the course. Let's bring this into real life with 3 versions of you. Example 1. Early career you. You're investing for decades. Your biggest edge is time and consistent contributions. You might be able to tolerate more stock exposure because you won't need the money soon and you can keep buying during downturns. Bogle even notes that some young investors early in their careers might reasonably be 100% in equities while they're building. Question: if you're truly long-term, can you treat downturns as shares on sale instead of danger? Example 2. Mid-career you. You've built a meaningful portfolio. Now volatility is no longer abstract. It's your real money moving up and down. The temptation to do something grows. This is where bonds can function like psychological shock absorbers. Question: would you rather have slightly higher expected returns or a much higher chance of staying invested through the next ugly period? Example 3. Near retirement you. Now sequence risk becomes real. Withdrawing during a bear market can permanently damage your portfolio. A bond allocation can give you spending stability so you're not forced to sell stocks at the worst possible time. Bogle reiterates the basic 50-50 idea with a 75-25 to 25-75 range, depending on risk tolerance and peace of mind. Here's another crucial point Bogle makes that people ignore until they feel pain. Your allocation isn't only about math. it's about behavior. He gives a practical example. A balanced index approach can offer meaningful protection in bad markets, like losing far less than an all-stock index during major downturns, especially for investors who might be cowed by volatility and tempted to bail out when things get rough. If a slightly more balanced mix helps you avoid selling out at the bottom, isn't that lower return actually higher real-world return? Now let's talk about the skill that makes allocation work: rebalancing. Rebalancing is simply restoring your target mix. When stocks soar, you trim back to your plan. When stocks crash, you add back to your plan. It's boring, it's mechanical, and it fights the exact instincts that make investors lose. So here's the key question. Do you want a portfolio that changes based on headlines or based on rules? Finally, Bogle mentions a famous rule of thumb. Bonds equal your age, with the rest in stocks. Then he immediately clarifies it was never meant to be rigid, just a place to begin thinking. That's the takeaway. Start with a simple rule, then adjust for your real life. Because the best allocation is the one that matches your timeline, your goals, and your nervous system. And once you have that allocation set, you're ready for the final step. Turning all of this into a simple, automatic plan you can follow for decades. So you stop relying on motivation and start relying on structure. Let me ask you a question that decides whether this book changes your life or becomes just another idea. What will you do when the next scary market shows up? Because it will, not if, when. And the difference between investors who build freedom and investors who build regret is usually one thing. They have a plan, and they follow it when their emotions are screaming. So here's the Stay the Course plan, built from everything we covered, packed into a few rules you can actually live by. Rule 1. Own the entire market. Instead of trying to guess winners, you buy a broad, low-cost index fund that represents the market. Question: do you want the stress of being right or the power of being diversified? When you own the market, you don't need a prediction. You need consistency. Rule 2. Make costs your obsession. Not because costs are exciting, but because they are guaranteed. Expenses, turnover friction, taxes, these are the silent thieves. Question: if returns are uncertain but costs are certain, why wouldn't you control the certain part? This rule alone can be worth more than any hot tip you'll ever hear. Rule 3. Choose an allocation you can survive. Not the one that looks brave in a bull market, the one that still makes sense when markets fall hard. Question: can you hold your portfolio through a 30% decline without selling? If the honest answer is no, the allocation is wrong, even if the spreadsheet says it's optimal. Rule 4. Automate your investing. Because willpower is unreliable and life gets busy. Set a monthly contribution. Make it boring. Make it inevitable. Question: what if the real secret isn't finding the perfect investment, but never stopping the habit? When you automate, you remove decision fatigue, and you buy through downturns without needing courage. Rule 5. Rebalance on schedule, not on feelings. Pick a simple rhythm, maybe once or twice a year. When stocks run up, you trim back. When stocks drop, you add back. Question: are you willing to do the emotionally backward thing? Buy more when it feels uncomfortable? Rebalancing turns volatility from an enemy into a tool. Now let's bring this down to a realistic moment you might face. It's late at night. You're scrolling. You see market plunges, recession fears, new crisis. Your heart rate changes, and your brain says, "Sell now, I'll come back later." This is where your rules save you. Instead of asking, "What should I do right now?" you ask, "What does my plan say I do?" Because markets don't reward high IQ as much as they reward emotional stability. And emotional stability isn't a personality trait, it's a system. Here's a final question I want you to sit with. If you had to bet your future on one edge, information or behavior, what would you choose? Bogle's answer is clear: behavior. Most people don't need a new strategy. They need fewer strategies and more patience. So here's your one-page action checklist for today. Look at what you own. Is it broad and diversified, or is it a collection of bets? Look at what you pay. What's your true all-in cost? Look at your allocation. Can you stick with it in a bad year? Set automation. Make contributions happen without debate. Set a rebalancing date. Put it on the calendar and keep it boring. And now, let's end with a hook that becomes your identity as an investor. Your goal is not to be brilliant. Your goal is to be unstoppable. Unstoppable means low cost, broad diversification, disciplined behavior, and time. If this video helped you, do me a favor. Like, subscribe, and share it with someone who needs a calmer, smarter investing plan. And if you want to break through even more in investing, whether it's building stronger habits, thinking clearer under pressure, or leveling up your long-term strategy, go watch my other videos on this channel. I've made a lot of content that will help you take the next step. Pick one that speaks to you right now, and I'll see you in the next video.